Thank you, everyone, for joining us. VC-backed Asian tech companies raised almost $20 billion this year, and the pace of fundraising activity is really picking up. Jishun, what's your view on that? But Harry and Melissa, feel free to jump in as well.
Well, definitely there's a lot of capital in the market. In some ways, it's catalyzing a lot of innovation, encouraging a lot of entrepreneurship and change that's happening in the market. So that's good. I mean, it's creating a certain momentum. But having said that, the competition among companies has definitely gotten more intense. And in some ways, I think it reduces the capital efficiency of the capital that's been raised and used. So that's a challenge. And so I think, for us in particular, it's trying to, identify with the right team, identify with the right entrepreneur, and creating the right differentiation and leadership over time. So that's a navigation that we need to do. Mm-hmm. So capital is a double-edged sword. That's what I would say.
Mm-hmm. What's your view on that, Melissa? I mean, is it picking up too much? I mean, do you have any?
Well, I think the good news is we're definitely off the highs of 2015. And I think when you go back and you look at the bubble that did burst in 2000, in 2001 in the U.S. is that we had 100 billion of capital, but it was pretty much U.S.-centric. And today, when you look at where we are, we're pretty much on the same run rate, but it's actually distributed globally. So even though I agree with Jishun, I think we have a lot of capital in the market, but it's not necessarily, compared to 1999, it's actually well distributed this time. But I think, yes, what we've actually seen recently, or in the last couple of years, is that these mega rounds, we've never seen this in venture capital over the, since venture was started, since the 1960s. And the question will be is we haven't seen the successes yet from a liquidity standpoint of what these mega rounds really mean. And I think that's going to be something that's going to become evident over the next 2 to 3 years.
Mm-hmm. But this pickup in valuation, I mean, is it a good thing? I mean, it's not bubble bursting sort of levels yet, as you mentioned, from a couple of years ago, but is it a good sign or a bad sign that valuations are picking up? What's your view on that, Harry?
I think someone said very, very well once that bubble is like beer. It doesn't taste good without it, right? So in some ways, you do need to experience the highs and the lows. And I think the question comes down to, there are how accelerated is the expectation of returns right now in the market? Mm. And when we look back, I guess, 10 or 20 years, I was finishing reading a report recently that said that in 1996, for example, all internet companies' market cap combined was about $4 billion. 10 years later, in 2006, that had risen to about $350 billion, or a multiple of 75 times. Accelerating that to last year, 2016, that number was now $2.6 trillion. Mm. So really, in the course of the last 10 years, we put on about $2 trillion of market cap. So it's created a lot of wealth for a lot of people. And so as a result, a lot of the companies that we see and meet with have this sense of accelerated expectation. Mm. The market's rewarded and paid handsomely to companies that have done very well. But at the same time, there are a lot more startups competing in the similar space that are simply not going to get there. And so there's a little bit of this misalignment between expectations and reality and the ability to execute so that you ultimately succeed.
Mm-hmm. Yeah, the one thing I want to add to Harry said is that I don't think it's one bubble, right? I think we have a lot of segmentation today, whether it's by country or by market segment. I think for us in fintech, we've already seen the bubble burst in the U.S. in 2 sectors, and I think that's you can't just say it's one macro bubble anymore. I think we'll see a little micro burst, and then I think for the great companies, as Harry said and Jishun said, the great companies will attract tremendous amounts of capital because today capital is readily available. But we have started to see some microbursts.
Mm-hmm. And in terms of sectors, I mean, a lot of the funds nowadays going into startups in China go to consumer-oriented companies, right? As the country is trying to shift towards more consumer spending. I mean, are the valuations for consumer companies warrant where they are? I mean, what's your view on that, Jishun?
I think certainly that, I mean, to Melissa's point, there's pockets of hotspots in consumers and, you know, ride sharing, bike sharing, all sorts of sharing. And these hotspots typically, when they get a certain, you know, momentum, valuation does actually climb ahead of reality. But I must say that I think China is now a more broad-based market. I think there's increasing amount of opportunity around enterprise as labor cost rises, as enterprise needs to be more drive productivity and efficiency in its workflow. There's a lot more adoption of technology. And for one, we are seeing adoption across the board, not just in tech companies like the DDD and C-Trip and so on, but also among banks. There are a lot more spending for, you know, AI-driven chatbot, for example. So we think that the innovation today, and Melissa mentioned this earlier, there's a lot more broad-based innovation, and capital is going into those. And if we are able to identify some of these spots before they get hot, you actually can get a fairly good valuation. So these hotspots actually come and go. And there will be a period of rationalization and consolidation before the full potential of that consolidated play get realized. So
I think,
go ahead.
Sorry. Well, to your question about which sectors are hot, just to add on to what you're saying, we think that the consumption story in China is probably going to be the most exciting investment thesis for probably the next 10 years to come. I think all of the macro data would suggest, you know, whether it's urbanization, per capita household income rising, et cetera, et cetera. Look, we've seen this playbook before. And what's transformational about the China consumer story today is that as household incomes rises from 3,000 kwai per month to 20,000 kwai per month, that per capita expenditure increase historically in other parts of the world has seen consumers enter new categories, shop from new channels, and their shopping habits change. You can benchmark that to our neighbors in Hong Kong, Taiwan, Korea, and Japan, and maybe in some cases to the Western world. But this curve, as we ride up from 3,000 kwai to 200,000 kwai, is the most transformational. And studies have shown that as they tailor off as their income rises above 20,000 kwai per month, the habits do not change nearly as quickly as the earlier on. So I think that's going to represent some really exciting opportunities. And last but not least, tech's going to have to be a big, big part of that, because that's what's going to disrupt and also enable growth and opportunities.
I moderated a panel on Tuesday where I asked, you know, other VC fund managers if they saw, you know, sectors that were looking like a bubble, and a lot of them mentioned, like Jishun, the sharing economy, right? Particularly funky areas of investment like umbrella sharing, things like that. I mean, Melissa,
they stole them all, right? Yeah.
Exactly, they all disappeared. Melissa, you have a focus on fintech. Any particular areas of fintech that you see might be, you know, reaching that level of silly valuations or you know, not very...
Oh, well, I think we've seen it. It's alternative lending. I mean, I think, you know, you don't need 3,000 alternative lenders in China. And I think one of the most interesting things, if you look at alternative lending on a global basis, is that in the US, you've only had really Lending Club and Year-End Die get public. And what's going to happen to the rest of the companies that are in the backlog? It doesn't mean that there's not great companies, but it doesn't mean you're going to get venture returns generated either. And I think people confuse two things when it comes to venture capital. There are great companies that can be built, but that doesn't mean the VCs are going to get the exits that we expect or need, you know, to satisfy our own LPs. So I think we've seen it in two areas: alternative lending and I want to say broadly, wealth management robo-advisory. So we actually did a chart last year, and we said, okay, these are where we see the bubbles. But then, as we look across fintech and AI globally, we're seeing lots of areas of new innovation. I think insurtech is clearly at the beginning, and also regtech. And so I think the way we look at it very broadly is, I think Ji-Shun said it, you have got to identify a space early. That is the name in the game of venture capital, and I don't care if it's 2017 or 2002. You've got to be early, identify it before other people recognize it, because once it's recognizable and the company has scaled with revenue, there's lots of money that can come in and back it, and then valuations get way ahead of themselves as far as where the company is on its curve.
Yeah. No, I would add that to what Harry and Melissa have said. So in the consumer space, there's still quite a lot of room for people to imagine and think. Because while the phone, the top 10 or 20 app is actually that timeshare or wallet share is very well occupied today. But there is still other touch points. So we are seeing a lot of innovation around the cars. Now, it's not just about autonomous driving or assisted drive. It's about a new generation of electric vehicles. It's a differentiated environment, and what else can you do in the car when your hands have more time or free? So that sort of leads to innovation around voice and natural language processing and other applications, and also around your homes. Amazon led a whole innovation around Echo, and there's a lot of talks around what Baidu or Alibaba is doing, how you engage consumers at home beyond the phones. There's a lot of stuff that you can think about and innovate in that, and we are seeing companies doing that as well. I think the other thing, which is around social, the phone is getting more powerful. The camera is getting more powerful. Short video is becoming more popular. There are new formats for users to socialize and engage with each other beyond text and images. So we are seeing innovations around social new norms for what we call the new millennium, like the 00后 and the born in the 2000, beyond 2005. So I think that's still a lot of stuff that you can think about. And I think a lot of time our job, as Melissa mentioned, is how do we identify with those trends and entrepreneur early enough? Hopefully, we are able to capture most of the value then.
Mm-hmm. And what's great about the autonomous vehicles, I think it touches almost every sector. Because if you think about even insurtech, when somebody crosses a street and an autonomous vehicle hits that person crossing the street, who's at fault?
Yeah.
And so it's going to change industries, whether it's consumer or the car itself or the peripheral industries. So, that's the great thing about some of the innovation we're seeing. It's no longer segmented necessarily, but it cuts across so many sectors.
Mm-hmm. Melissa mentioned earlier that we've seen already some microbursts happening here and there. Harry, where are you seeing in the consumer space, the valuations crashing because there was just too much money going in? Some of these micro bursts happening.
I think I think we have to acknowledge that China is probably one of the most competitive markets in the world.
Yeah.
and those of you who are here to raise money would know that the cost of starting a new venture has come down exponentially, even compared to 5 years ago. Mm-hmm. Right? The cost of funding a startup 5-10 years ago would have required anywhere from maybe $5 to $10 million to write your code, buy your server, get capacity, design, and so forth. Today, you could simply go to GitHub, get open source, write the last 10-15%, and you're in business. And your speed to market has simply accelerated. And as a result, that's going to attract a lot of competition for whoever has an interesting proof of concept. And because there are an abundant amount of venture capital firms in China that are going to bet on a certain hot industry, you really have to be very, very smart about picking the right ones. And as a result, that's going to lead to an oversupply of funding for an over number of competitors competing in the same space. And so inevitably, it's going to lead to a number of flameouts. And what we're seeing now, some consolidation. In Shanghai, if you guys travel to Shanghai with bike sharing scheme, the joke in the market now is the bottleneck is really not capital. The bottleneck is not bikes, but the bottleneck is the number of colors there are. Because every bike and every company has a different color, and they're running out of colors to brand themselves. So, I think eventually the guys that are going to be out execute and get scale, have access to funding, are going to ultimately win out.
So, Harry, which color is going to win?
I think it's going to be a rainbow.
Well, beyond the volume of venture capital, funds that are being raised, you also have corporates participating quite strongly in the market. I mean, Melissa, do you think there are just too many players out there? I mean, how do you guys compete not only with other venture capital firms, but also with this increasing number of corporates in the market?
So in our sector particularly, there's 40% of all fintech companies in Asia have a corporate VC. And I think there's different levels of corporate VC. We've seen this before in the past. And I think if you're an entrepreneur, you have to ask yourself a couple of questions. What do I want from my partner, whether it's a venture capital firm, corporate or not? And I think a couple of things with the corporate VCs. I think depending on who they are, it really will take a company in a specific direction. And so therefore, you have to decide whether you want to align yourself with one player in the market. I also would say, from a CEO's perspective, you have to decide, what do you want in addition to money? And for example, for us, we have the largest and deepest strategic network of financial institutions in Asia. That's something that we bring in addition to money. But it's about mentorship and helping somebody. We're their partner. We can help them build a company. And I think we don't. The only time with corporate VCs is sometimes they do overpay. And if they overpay compared to what we think is the right value for a company, then you move on and you look at another company. But I would say it can work both ways. But the question for an entrepreneur is, will that corporate VC will continue to invest if we see a downturn in the market? And I think that's a good question for an entrepreneur to ask their venture capitalists as well.
Mm-hmm. I mean, Jishan, we just had obviously the big launch of SoftBank's, giant
Vision Fund.
Yeah. I mean, do you see that, as a issue of concern, perhaps pushing valuations even higher? I mean, more competition?
Well,
are they going to be able to deploy it wisely?
It's a great exit strategy for early stage.
I was just going to say that.
Yes, it is.
I was just going to say that. I mean, it's a lot of money. It's $100 billion, right? And I think it's both. It's definitely providing more ammunition to the portfolio if they invest, and alongside with that is dilution. But there's also a choice. You also create an exit opportunity. So I think what we are seeing is with large corporate funds, be it from SoftBank or Ali or Tencent and so on, it's also creating a different exit environment for us. Exit is no longer just saying that I have to stretch through an IPO, wait through a full M&A before I consider an exit. Exits today, if you look at Didi or the likes, there has been good secondary sales, which create an exit for earlier investors. So I think that's how we would think about it. It's always a function of risk versus reward and time that we have to consider. So I think for most parts, I think for most venture firms and funds, it has to have that time consideration as to how they think about their exits and choices.
Mm-hmm. Well, thank you very much. I think we're running out of time. Thank you, everyone, for listening. Thank you.
Okay.
Thank you.
Thank you.